Welcome everybody to the June webinar. Thank you for everybody that's joining in. We thought this month's topic would be very telling as some things are stabilizing in the marketplace, and have two different panelists that are in the same line of work but do very different types of properties and different property sizes and amenities and things like that. So I thought it would be an interesting way to hear some different perspectives of what's going on in the market, from kind of the highest of the high end to some of the smaller properties in town, because a lot of the information that we at least see out there typically deals with more of the large Class B, Class A properties, and so sometimes that information is similar to what we see in throughout the asset classes and sizes, and some of it is different. A couple of quick points that I just wanted to say about what we're seeing and hearing in the marketplace. Rent collections per NMHC today are 92.9%. On the deal side, obviously Nexus Commercial Realty, we are apartment brokers, so we are always looking at deal flow and how are things coming. We've put 11 deals under contract this month, worth about $27 million, so that's definitely picking up quite a bit. Another little interesting stat that I was told yesterday, we've done more BOVs / listing presentations, whatever you want to call them, in June than we did in February before all this started. And in February, we had a pretty busy month. So I think that's telling of kind of where people's headspace is at if they were thinking about selling in 2020, potentially coming back into that fold, or just double checking and seeing where if values have dropped significantly or not after COVID. And not after COVID like it's gone, but as it becomes less prevalent and the economy opens back up. Something else we're seeing a ton of is debt questions. Obviously, our panelists today are on the third-party property management side. The debt markets are still very well. Fannie and Freddie still have a lot of stipulations with their loans, but are doing loans and have good interest rates. We are seeing the local banks again become more aggressive. They have cheap money. In the U.S., about $2 trillion. The local banks have been $2 trillion have been deposited since the start of COVID. Was the stat I heard the other day. So when you have that much money sitting in the bank, they don't make any money. It's just sitting there. So they need to get it out the door and they need to lend it. So I think the local regional bank players in the multifamily space will continue to be very active when a Fannie or Freddie deal might not work out. With that, I'm going to let each of our panelists introduce themselves. We do have a switch compared to the invitation. V from Boutique Wheelhouse had a last-minute thing he needed to attend to, so Nick is stepping in his place. And we'll start with you, Nick.
Okay. Hi, guys. I'm Nick Costanzo. I've been the president and COO of Boutique and Wheelhouse Apartments, so part of Portis LLC. For about 8 years now. Prior to that, I was with Equity Residential, so got my start on some of the larger properties on the REIT side, and then moved over to the third-party side. Between our two brands, Boutique and Wheelhouse, we manage right at 4,400 units in the greater metro area, and our assets range from 8-unit to right at 200 unit that has its own staffing and everything in between. So our asset class is pretty diverse, but does tend to stay on the smaller individual owner side.
Perfect. Thanks, Nick, for joining us. And Mr. Brandon.
Yes, welcome and thank you. My name is Brandon Rich. I am with Greystar Real Estate Partners. I'm a managing director and I oversee our property management operations in both our mountain and desert divisions. And so that's really kind of all the mountain and southwest states from Utah to Arizona, Vegas, and oversee a portfolio of about 110,000 units. It's about a $20 billion portfolio, and, you know, primarily A and B assets. We do probably manage somewhere in the neighborhood of about 5 to 7% C assets. So That's been with Greystar for a total of about 18 years. And I'm actually based in Denver. Our portfolio in Colorado is about 35,000 units.
Awesome. Well, thank both of you for joining us today. I think we've got some good questions here and some topics to go over that we at least are hearing on the brokerage side, and I'm sure you guys are hearing pretty regularly from your clients some of these answers. I also wanted to take this time to say there is a question and answer function for everybody that's tuned in right now, that if you have questions on a particular topic we're going over, please type them in there. I will monitor that and make sure we try to get as many questions answered as possible as we're going through this, so we can make this more of a discussion than just us chatting. So please feel free to type those into the question and answer tab on the bottom of your call. Okay, well, first I wanted to start. I looked up NMHC's stat this morning, 92.2% collected for the nation. Everybody wants to know, where are we at with collections, and do we have a backlog of delinquencies coming at us? And does that differ depending on the size of property, the location of the property, maybe the A, B, C type assets? And I know that's kind of a very long, big question, but Nick, you want to take a stab at that, where you guys are at with that?
Sure. As of today, our collections are at 89%. So we're a little below the national average, and it is very, very differentiated by the asset type. Our A-class properties are essentially business as normal. Then on the other side of it, on our C-class, what we've had and what we've seen since the stay-at-home order was issued, since the pandemic started, is we have about 2.5% of our tenants that haven't done anything. We've been proactive, offering payment plans, et cetera, but that 2.5% has gone from April to 5% in May to 7.5% of our delinquency now in June. So those are what I'd call our unresponsive tenants that haven't, done anything to try to work with us and move ahead on it. Additionally, we have about 1.5% of our delinquency is made up from payment arrangements and deferral plans. We put those into place early and have been offering 3 to a max of 4-month payment arrangements where the balance essentially just gets kicked down the road a bit, but that is contributing to ours. What's left over after you take those two things out of play is about 2%, which at this time of the month is close to what business as normal would be. So the vast majority of our tenants are where they need to be, but the ones that are struggling are creating where our delinquency is higher than even the national average.
Cool. Brandon, where are you guys at?
Sure. So I would, I think, just to answer your question, is there going to be a backlog of evictions? And kind of the short answer will be yes, because we haven't done evictions, in several months now. So even if you just take if you would have taken your normal evictions and put them on hold, then we do expect that we will have a higher number of evictions because they're not spread over the 3 or 4 months that we just went through. But when you look, our portfolio has historically ran about 1.4% delinquency pre-COVID. And, in February, that bumped up. In March, that bumped up to about 2.11%. And then in April, it went up to 5.3%. And then in May, we went back down to about 4.5%. And as of June, right now, we're about 4.7% delinquency. So, the same, we've worked out a number of payment plans. So this is exclusive of the payment plans, but have a small number of people on payment plans. Large number of payment plans when you do the unit count, but, it's somewhere in the, 2% range. So it's going to get interesting here in the near future to see how, now that we're starting to move forward and able to offer demand notices and proceed on evictions, it's going to, potentially affect everybody's occupancy a little bit and cause movement into the apartment space.
Sure. Nick was describing kind of their A class is business as usual. I don't know how you guys classify your whole portfolio, but I know you guys do quite a bit of that A class. Some people starting out in this were really worried that top end was going to be hit because it's the most expensive, out there. I mean, I, for one, haven't heard as much, but I'm curious to see just on you guys' top end stuff. Are you seeing that that's pretty steady Eddie still, or is that where are you having those delinquency issues? Is it in one class or is it kind of mixed throughout?
Sure. So I would say that, like Nick was saying, when he's kind of quoting by class, I think our A-class properties have been about 250 basis point below on collection. So they've been hovering, right around 3 to 3.5% delinquency. So the collections have been better on our A-class for sure. Where we've seen some of the disruption in that high end of the market is really on the leasing side. So, we went in with some of our lease ups, continuing high velocity and getting, between 27 to 35 leases a month. And, really in March, that dried up on the top end of the market. And now it's starting to come back a little bit. But it seemed that, when people were looking for apartments, they were really out there value shopping. And so, we have seen a disparity in class. And so, for instance, on the collection side, you hit a little harder on the B's and the C's, but on the velocity and occupancy side, we've seen a lot more activity on the C's and B property.
Yeah, that would make sense.
Yeah, I'd agree with that. Yeah. What I'd add to it is on the A properties, although the delinquency has been very good, we have had, much more lease breaks and skips. And a lot of the lease breaks are paying lease break fees and doing, what they need to. But our occupancy has been impacted by people leaving prior to the end of their lease. Our leasing velocity, I'll agree with Brandon with one caveat. Our A's and actually our C's are leasing at a better pace than some of our, call it the B- type properties, where it's heavily service industry related. No reliance on government assistance, just your service industry folks. That specific section of our portfolio is struggling to get the leasing velocity back up to where it needs to be this time of year. But on both bookends of it, the A's and even the bottom end, the leasing velocity is moving well since we were able to start touring again in May.
That brings up another question. People have been moving around a little bit. I mean, I think a lot of that's a necessity to move, whether a lease was coming up and or breaking a lease because maybe they're trying to look for a cheaper place, but they can afford to break their lease. But how does leasing look today? I mean, we were obviously in this day and age, everybody's trying to figure out technology and can we do this virtually? I mean, that was a conversation that's been had for years in our industry. How are you guys doing leasing today? Is it all virtual? It is a mix. Are you requiring certain things to show units? Are people doing virtual tours and signing leases without ever actually walking in the unit? Just more of a curious question. Nick, how are you guys doing it?
We're doing a mix. When this started, we went to straight virtual, and I was relatively shocked that our leasing didn't fall off as much as I thought it would. We wound up in April, we were 35 to 50% of our normal leasing volume, and that was all remote. Once we were able to offer both the virtual as well as face-to-face, we're back up right now to about 90% of what I'd want to see. So that jump has been good. We've been asking people how they wanted to see apartments since the beginning of this. And in April and even into early May, we were about 70% of our prospects preferred virtual. Now we've seen that percentage tick back down, but even as of today, we're at 50% of our prospects want virtual, 50% want face-to-face. One thing that's kind of special to our size of company that's impacted us is we've stopped showing occupied apartments. And I don't know if that's ever going to come back. But on some of our buildings that are 20 units and you're trying to pre-lease one that's on notice, we've lost that ability to do anything but virtual until it becomes vacant. The larger properties have models, you're able to still appeal to the folks looking for a face-to-face tour via the model. So for us, that's been tough on some of our smaller properties. And at the end of the day is going to lead to a little tick up in vacancy just by needing to wait till apartments vacate to get them released.
And is that more of a company policy, or is that a, abundance of caution, don't want to put people at risk? I don't believe that's something that's a law or something they've made everybody do. Is that just something you guys said, this is the thing we need to do to make sure we're being overly cautious for everybody, tenants and leasers alike?
Yes, from talking to our tenants as well as even our staff, these last several months and even right now, inviting unknown people into your home while you're living there, just is a rough thing. And obviously, if we had continued it, I'm 100% certain that we'd be receiving a lot of backlash and requests to not show the units from current tenants. So to respect their privacy and allow them to not have to worry about who's in and out of their place, we stopped with the occupied.
Brandon, how about you guys? I assume you're doing virtual. Are you doing only virtual? Have you got a mix going at this point? Where are you guys at with leasing?
Yeah, so initially we started out just virtual leasing. And then I would say about 30 days ago, we also implemented self-guided tours where residents could go on and register, and we had a mechanism so they could go through the apartments and view them, physically, but also by themselves. And then we went to appointments only. And right now we're at a point where, we're actually offering all three, and some of our leasing communities are taking walk-in traffic as well. So, some of them are almost back to fully operation. And, we did see leasing velocity drop off. We saw, traffic dropped off drastically in the beginning, but the closing ratio went up. And so the net effect was, about a year ago, our stabilized properties would average somewhere between 3 to 3.5 leases a week on average. And that went down to, somewhere between 2.5 to 3 leases a week. But recently, this last couple of weeks, we have seen our leasing activity pick up again. And we're now at the same levels we were as last year. They came back first in our suburban apartments, and now they're starting to pick up in the downtown apartments.
Interesting. And then when you're doing self-guided tours, do you feel like, because correct me if I'm wrong, but you guys train people, your leasing agents, they're there to try to get them to sign up that day when they're doing that tour. Are you seeing a different ratio when people are doing virtual and self-guided because they don't have that potential nudge than with a leasing agent walking the property with them?
So I would tell you that on some of the self-guided tours, we've only been implementing it on our properties for about a month, and that hasn't been, completely across the board. And there are a number of different products that you can utilize to do it. But even though that they are taking a self-guided tour, that doesn't mean that we're not in constant contact with them the same as if they would be doing a virtual tour, or even, in person for that matter. We've had, went through and invested in a lot of technology. And so all of our applications are done primarily online now anyway. So even if somebody comes back into our office, they go online and fill out the application and can do the entire move-in process. So I don't have the exact data, but I'm expecting that it's going to be very similar across the board, because nobody's really out just kind of, before you'd get people that would just pop in to look at an apartment or want to see what it looks like because it's a new deal, coming up in the neighborhood. And, with the COVID and all that. We're not getting a lot of people that are just kind of what we'd call looky-loos, right? They really do need an apartment. And so the closing ratios had went up, considerably. They went from, around 30% from a tour to a lease to, in some cases 40, 50%, in some cases, a little higher than that. And so what we're really trying to do is just make sure we meet our prospective residents where they feel comfortable. And today everybody's feeling a little bit, has a different feeling of what their comfort level is. Some people want to wear masks, some people don't, right? Well, some people want to see the apartment and they don't mind being with a leasing agent, and others, they still want to see the apartment before they lease, but they prefer not to be with the leasing agent, but their motivation is still all the same.
Sure. Totally makes sense. Speaking of kind of going into apartments, and a quick reminder, everybody that's on, if you joined us a little late, there is a Q&A button at the bottom of your screen. If you have any questions about a particular topic or just a topic you would love for Brandon and Nick to discuss, please let us know with that. Happy to try to answer as many of those as possible. Speaking of, we're just talking about the comfort level of tenants and people entering their apartments and strangers entering their apartments. I know in the beginning of this, it was kind of emergency maintenance orders only were kind of what everybody was doing. Where are you guys at as far as maintenance orders and going into people's units? And do you have a system around that or a process around that? And then kind of a bigger question, I know a lot of capital projects that owners were doing, I believe mostly got put on hold. Is that still the case for most of you guys as owner, unless it's obviously something that's absolutely necessary? Any kind of quote-unquote upgrades? Nick, what are you guys seeing on that? How are you guys doing that?
We are back to taking care of all of our maintenance requests. However, what we're seeing is based on individuals' comfort levels, our volume of maintenance requests isn't what we'd expect. It is slightly lower from people that are dealing with, be it the light bulb out or whatever it is, they're not calling it in. When we are doing work requests, we're doing a screening with the tenant if the tenant's going to be there. We're asking them the same questions that we're asking of our staff, then making the determination of how to handle it from there. Also asking tenants if they will be there to be wearing a mask. Our techs are obviously doing all the PPE, masks, gloves, sanitizer, wiping down every surface that they touch, et cetera, on their way out. And the majority of our tenants are very comfortable with that. We still have that, I'd say the minority that are still not wanting anybody in their apartment, so they're less likely to put in a work order, and it's more of a coordination on our end when we do need to get in to do something. As far as the capital projects go, the majority are moving forward. The majority held basically for the month of April, kind of into maybe a little start of May, but the majority of things are moving forward. Where we are seeing a little bit of slowdown is on some of the unit renovations that weren't, kind of the one-off unit renovations, taking a little bit more wait and see attitude on some of those. Some of my clients are, but the vast majority of our capital projects are moving forward.
Brandon, what are you guys seeing on the maintenance side and capital project side?
Yeah, so I would say similar to what Nick is seeing. I would, probably about 25% of the anticipated projects we had were put on hold initially. We did go to emergency service requests only. We also did a number of kind of DIY videos or how-to videos for our residents that, wanted to, had an issue with the light bulb out, a breaker, or, a toilet that needed to be plunged. And we would provide the supplies and tools and allow them to do it. And so we're continuing with that. We're back open, that would do the request, but we're still, if a resident doesn't feel comfortable with us coming in, providing the supplies necessary to do it, as long as it's something that is, very simple. as far as capital projects, the capital projects that mainly got shut down were the ones that required us to enter into units. A lot of our unit renovations got put on hold, and then we went back to only doing, vacant units. It would be a little bit longer time to get them ready because we couldn't go in and pre-measure a lot of the, the cabinets and stuff like that. But now I think we're almost back fully operational in all those areas, and a lot of those capital projects have come back online. So yeah, probably similar to what Nick's seeing out there.
Do you feel like with the people that are maybe not comfortable with people coming in their unit, that they're not reporting some issues that are going to turn in, what may have started as a small issue 30 days ago is going to turn into a bigger issue because that one tenant is not willing to have somebody come in their unit, so they'd rather just deal with a leak or something like that?
I don't think there's any of those big issues. At least I'm hoping there's not any of those. We haven't discovered anything like that to this point. The majority of it would be something along the lines of, one burner on their stove not working. Normal inconveniences that would be typically taken care of in 24 hours might be sitting there now for a few months. So whether those people get comfortable with us back in, or we take care of it at some point in the future on a turn or unit inspection, I don't think there are major issues that are out there.
Brandon, any major issues you see arising from some of that?
No, I agree. They're the minor issues, and I think that we were able to get some of those resolved by like the light bulbs and stuff like that. And at some point, we'll probably get in and get to fix the lighter issues. But we've been, residents have been good at reporting some of the major issues. I mean, we've had leaks and floods, and have been able to get in and get those repaired.
Brandon, this is probably more of a question for you. I mean, you guys manage a lot of highly amenitized buildings. Where are you guys at with opening some of those amenities, and what precautions are you taking, and what amenities may not open for a while?
Yeah, so that's interesting. I mean, clearly we have a pretty diverse group of clients, and so they all have a different tolerance for risk. And so I think we have a little bit all over the board. I would tell you that for the most part, the majority of amenities are opening. I would say that, they're limited. So for instance, fitness centers, pools, even pools where, we're required to monitor occupancy, there's limits to them. So we're having our residents having to sign up to utilize them so we could enforce occupancy limits. But we have some clients that are, we put up the notices and let them kind of self-monitor. And so, that's been one area where I can tell you, the residents have been eager and to get back to using their amenities, because that's why they, have leased a lot of these apartment buildings. But you have other residents in there that, they don't want the amenities open because they don't want people, being in there together. And so that's been really a tricky to navigate. And, we've been following CDC guidelines, and, a lot of the areas we have to clean off on the hour. So it's added a little bit of different extra expense onto, what we normally do. But that's something that is probably the trickiest part of what we're doing right now, the amenities.
Nick, I know you guys obviously have properties with amenities, but some without. What are you seeing on your amenitized properties as far as opening back up and the residents' feelings on that?
Yeah, I'd agree with Brandon that a lot of it comes down to client comfort level. We've been, and a lot of our properties don't have the staff to simply be able to add, the hourly cleaning for a pool. So we're kind of running the gamut on some of the things that we're doing. We've removed all pool furniture from some. We have our maintenance doing the wipe down and allowing kind of self-monitoring. And then when we're coming by, checking to make sure we're not having an occupancy issue. We're doing some self-monitoring from our tenants, along with, plenty of sanitizer, plenty of PPE at some of our fitness centers. And then conversely, I've got, some pool areas that we're likely not going to open this summer due to just kind of a conservative nature of it. From a tenant basis, the ones we hear from want them open. So we started opening pools, well, a little over a week ago, and knock on wood, but to date have had, no issues. And I think I only have, 6 pools open at this point. But so far, no problems with it. And the tenants are happy to have use of some of the spaces that they paid for and helped them decide to move. So.
I definitely see that. Brandon, I think you and I chatted in maybe April, kind of mid-April, right, when this kind of really was getting going, and you'd sent me, I think, a white paper or something about the future of the apartments and cleanliness and how often you're cleaning, and all of these things almost become a selling point, just like your pool and your fitness center and your little workout area that also has a place with a kegerator or whatnot. Are you seeing more people during leasing ask about those sorts of things, especially in some of these kind of larger, higher-end properties?
I wouldn't say that during the leasing process we're, having those type of questions. I would tell you that during, we still have a robust pipeline of deals in various pre-development state, and they're continuing to go through. And so our clients are definitely, honing in on some of those areas and asking, a lot of touchless entry. We've had questions on and trying to really, but that happened pre-COVID. And so I think it's really focusing on, accelerating some of these technologies that would, make things more touchless. Some of the amenities where, we put in these smaller, convenient lockers, if you will, that are stocked by some local groceries and grocery delivery places, and they also have other supplies in there. So we're seeing those type of things that are coming in. I think one of the other things that is broadband and Wi-Fi. We've been trying to preach that to our pre-development clients, because especially once you start getting into high-rise and mid-rise, sometimes the products being used limit the limit how well the Wi-Fi goes through a building. And so, today we know that was important prior to pre-COVID, and then during COVID, that became extremely important. So I think you'll see people investing, in broader Wi-Fi. We went from package storage lockers to starting putting in, locker rooms, and, even with the extra delivery systems we have in place, our sites are getting inundated with deliveries because everybody's ordering online. So I think you're going to see, more robust delivery systems and technologies that come to communities. And then we also, we've been putting in a lot of concierge services, and whether they're virtual and they have, they can order like dog walkers or people to pick up their clothes or food delivery, stuff like that. And so we're starting to see a lot more demand on those, and people inquiring to, continue to put those type of amenities in their buildings.
It's really interesting. Nick, anything to add to that?
The access systems and parcel lockers were really hitting the nail on the head, especially on some of our smaller properties. To some degree on our smaller properties that have no amenities, people have been home so much that package deliveries have gotten a little bit simpler, but the access systems need to keep up with them. And that's something that was coming and was part of new developments, and even, going back in and retrofitting some older product. But having that in place that's going to allow for seamless self-showings, for comfort level of existing tenants, as well as for any number of delivery services. It's going to be just more and more important. And we're moving, a few buildings that way now, because I think in addition to the amenity side, the leasing side is definitely changing. Virtual self-showings are going to be as important as face-to-face ones. So having an amenity that also fits that benefit makes access systems all that more important.
I agree with that. And something that we've been hearing and talking about, and we do some development land on the brokerage side. It's been a big push of ours lately, and seems developers are still pretty active, is, what does the apartment of the future look like? Obviously, a better way to handle packages has been talked about for years, as the rise of Amazon, and I think obviously is just getting pushed more to the forefront throughout this. But the thing that's obviously happened during this is people working from home, and there's been a lot of very large companies come out and say that may be something we do permanently, or we do more of than we ever did in the past. Do you guys think that there come a new amenity out of that, where, hey, I work from home, but I don't want to sit in my apartment all day. I'd like to go somewhere else inside the building and be able to plug in and have Wi-Fi and quote unquote work from home, but not be sitting in my kitchen or right next to my bed, because I may be living in a smaller apartment that I don't have an office set up, if you will, at home. Do you think that will continue to, be popular, or something that developers are looking at, Brandon?
Sure. So I would say that that's really, something that started, a few years back, right? Because people working from home has, been getting more popular, and this just accelerated that. So I would, think that that's going to continue. We've been designing spaces where people can, go into our, club rooms, or we have extra office spaces in there, and we have extra meeting rooms, etc. And our residents, those are very popular amenities. They're laid out in a way that they could still social distance. And so I think that will continue. I think the bigger trend to watch is, to see if there's anything that comes out of, how we are, not just in COVID, but, with the social unrest and everything. I mean, the downtowns have been hit pretty hard. And so, we're seeing, people are, number one reason for move outs now, again, is home purchases. People are, absolutely out looking for homes. I think that a lot of them are, headed towards the suburbs. And so, to your point, as people that no longer have to go into the office, are they going to continue to want to live in downtown with the unrest? And, when all that settles down, do they, migrate back there, or do they start, continuing to migrate to the suburbs? The suburban properties were strong. They came back the strongest, even on all ends of the spectrum. But the A's, where the high end of the market started slowing down, our A plus, they came back in the suburbs first. And so, I do think that, those communities, they're probably going to build them a little bit, larger properties, or start putting in some areas where there is space to work in from home, as well as in the amenity space. But to see what are the trends long term, are the urban cores still going to be as popular as they were, prior to all this, is going to be interesting.
Yeah. Nick, are you seeing the same thing with the kind of core product versus the suburban product?
Yeah, I agree with that. I think another thing to consider is your dollar gets you more square footage in suburban. So one thing we've seen on our studio product is, with the lack of the amenity spaces, with the lack of being able to use that lounge, a lot of our studio folks are looking to move more towards suburban areas. The civil unrest, the homelessness, and some of the things we have going on specifically in the downtown urban core of Denver, are going to slow the recovery for some center core assets as far as rent growth goes. As far as home ownership goes, I think you can argue it a couple different ways, and we'll have to see what plays out. The ability to work from home is, certainly a good thing, that people will be able to go to the suburbs and not worry about being as close to their downtown office, because they only have to go there once or twice a week. That could lead some people to more home ownership. But then again, on your class B and C, you have kind of tenuous job security that's going to keep people deciding to rent for a little bit longer. So, I think there'll be differences in the classes on the amount of people moving to home ownership versus staying renting. But I think square footage is a big thing that the suburban properties offer just a little bit more of for anybody that was locked down in a studio. They've probably had at least a couple thoughts about moving to the suburbs.
Sure. And I can tell you some of the things we're hearing on the home ownership side. Obviously, debt in the single family side is very cheap right now, and I don't think that they've seen hardly a blip on the single family sales. If anything, there's still very low inventory and more buyers than there are sellers. Some of the things that I've read and seen online is, but some people that were maybe saving up, that were living in one of those buildings downtown, that were saving up, maybe it was a couple that just got married. Well, maybe one of them lost their job. So now they're kind of burning through some of that savings that they might have been saving up for that down payment, or just don't know how much their job security is. So I've seen some reports saying we might see some of these people actually stay in rentals longer, that we're maybe looking to make that transition. And we're all Denver people, so we're speaking more to Denver specifically. So I think you can, to your point, Nick, I think you can argue that a couple of different ways. I think you can say people want to get out of the city and move to the suburbs and more space and try to buy a home. But I also think, if you guys have been out to dinner, you go out to dinner in one of the popular neighborhoods like the Highlands, and right now, it's pretty robust amount of people that are out. Obviously, all these restaurants are spacing tables out and doing what they need to do, but it seems like people are ready to get out and socialize to the new norm. Speaking of getting out of the city, that was kind of one of my questions that, and I don't even know if you guys track this, but I'm more curious as the New Yorks and the Bostons and the San Franciscos got hit really hard, and a lot of those bigger kind of tech companies and other companies have said, hey, at least a portion of our workforce, we could do without them coming into the office maybe once a month or once a quarter or something like that. So are those people then saying, okay, well, I don't need to live in this big city. Number one, it's cramped. I live in a studio. I pay a ton of money for it. And number two, the outbreak was way worse there, and I'm scared of it coming back. So I'm looking at a Denver, I'm looking at a Phoenix, I'm looking at a Salt Lake, or a Boise or something like that. Are you guys, again, not sure if you track this, but are you seeing a good amount of activity from that out-of-state person moving in, or is it kind of standard? I know we've always had a great immigration number to begin with of people moving in, but have you seen any uptick from some of those bigger metro areas where people are just trying to get out of that city and get into Denver or something like that? Brandon?
So, I guess that's a yet to be seen, right? I think those announcements are just happening. Nobody's really on the tech side hired thousands of people yet, and so we don't know how that's going to shake out. I think the bigger thing is going to be, talking again like we did about core assets and downtown to non-core assets. Right now, as I think Nick touched on it, but there seems to be more homeless down there. There also seems to be more crime happening in and around our communities, and the police response is very slow. We get police telling our community managers that, they really are not going to arrest anybody unless it's a serious crime because of the COVID. They don't want to take people to jail. And so, there's a lot of crime happening higher than usual. And so I don't know what the long-term effect of that is going to be in the downtown area, right? So I don't know, how that's going to play out. I would say we've seen people moving, in and out. I think there's been people that have left our communities and moved out of state just because they're going home, especially some of our younger residents that aren't sure about their job or they lost their job and have moved out. And but we still have people moving in. So none of that, the shakeout hasn't happened yet. I think the government came in and, artificially supported everybody, which, has been a tremendous help. But that's ending, unless they re-up it. And so, it's going to be interesting to see, even on the home buy side, on the occupancy and, continuing to fill these apartments, if we do go to, stay at above a 10% vacancy and people aren't getting enhanced unemployment insurance, there's going to be movement and shakeout, just looking back at last recessions, because, we may go through some type of recession that was like a historic recession instead of what we went through with all the government support. And so I think that, while everybody was pleasantly surprised of how well we did through the last, 3 or 4 months, I think that the real tale is going to be, what is the next, 6 to 8 months. And I think it's going to be different in different markets, because we're seeing it already. Places like, Colorado has held up pretty well. Utah, seems to be still very strong. They're very pro-business. And so I think when you're talking about, businesses moving and relocating out of downtowns, that's like a great area to go to. Albuquerque has just been kind of steady Eddie. Phoenix didn't really get hit that hard. When you look at their collections, they were probably anywhere between 1 to 2% lower on delinquency on average than we were in Colorado. And there still seems to be a lot of activity there from a jobs perspective. But then you go to Las Vegas, and it's a whole different story, right? Like the average collection there or delinquency was closer to like 12%. So it was a lot higher, and it doesn't seem like their economy is going to come back as fast. And so how things shake out is going to be very interesting, and I think we'll really get to see in the next 6 to 8 months.
Yeah, and that's what I always tell people that are looking at some of these national reports on, rents and vacancies and collections is that's a national average. Every market is going to have its own, and even within every market, is it an A class versus a B class versus a C class? Is it a 50 unit versus a 200 unit? So you really got to dive into those numbers to really make sure, if you're looking to compare apples to apples on a deal, that you're comparing the same thing, because a lot of the information out there is not the same. Nick, I think Brandon just talked about, a couple of bullet points that I had left here, and I want to leave some time in case we have some questions. But
Yeah.
Obviously, unemployment, the $600 a week is coming to an end here in a month. Everybody got stimulus, or a lot of people got stimulus checks in the last 90 days. We have a backlog of evictions, just whether it was a natural backlog, because we always have evictions regardless of the market, or people may be playing the game of, hey, I know I can't get evicted, I can maybe even afford to pay it, I'm just not. How do you think that, and this is asking for everybody's crystal ball, but how do you think all that plays out as we come to an end of the second quarter and go into this third quarter?
Well, I think a big concern of mine is what's going to happen with the next round of stimulus, if there is one or if there isn't. I think when we look back at these first couple months and how properties performed is almost going to be anecdotal. We're not going to really know the true impact, specifically on B and C, but A as well, until the stimulus runs out and we see what's really left behind. I think that's going to allow us to determine, specifically for the Denver market, if this is just a pause in our good rent growth and continued good trends in Denver, or if we're going to be receding for a little bit of time before it recovers. Long term for Denver, I think the amount of people that are getting more comfortable working from home, working remotely, is going to give more flexibility. Nothing's changed for Denver being a top tier goal for pretty much every college graduate. It's up there on their top list of where they want to go. This might allow more of that and more industry coming in. So I think at the end, Denver's going to respond strong, but these next 6 months, just like Brandon said, is going to really be telling. I don't think it could go any direction, and we haven't seen it yet. For evictions are not going to be up on a year-over-year basis. We just have to deal with that backlog. Unfortunately, the way this has all laid out is the property owners bear the whole burden of the moratorium and the time frame, and that bad debt number is going to be inflated next year because of it. But the general number of evictions is not going to be up in 2020 over what it was in 2018, 2019. It's just the timing of it. And I'm certainly hopeful that some of our delinquency is due to tenants sitting on the funds and waiting to pay until they actually get a true demand, which we'll find out in the next month or so on that.
Sure. Speaking of working from home, I probably should have started with this, but our office is back open on a volunteer basis with obviously some guidelines around that. Curious to hear where you guys' offices are at.
Well, my office is open for office staff with no requirement. A lot of us are doing, 3 to 4 days a week. And then I do still have some staff members that are haven't felt comfortable coming back in. Then our line staff, of course, needs to be our line staff, so they're out and about. But our leasing offices still are not open to tenants. We handle everything via phone and email. And get everything communicated, but we're not having walk-in traffic at this point. I think that'll change here in this next month, but it's been relatively successful. So,
Brandon, where are you guys at on the office side?
Well, so I think I mentioned earlier, our majority of our leasing offices are either completely open or at least open for walk-in tours right now. And I think we continue to open up more every day. Our corporate offices, we had invested a lot in technology, and so it was a little bit unnerving when we had to, have everybody go home. But, I think we were pleasantly surprised on the productivity of everybody working from home. And so while we've been focused on really the operations of our property, we've kind of put our offices on hold. So there are people that go in on an as-needed basis. It's never really technically been shut down, but, we haven't required anybody to go in, and I don't think that we will start requiring anybody to go in until after Labor Day. And then even then, we're going to evaluate on who needs to be in and who doesn't, because again, it's been a very successful people working from home, and we've gotten surveys from our team members, and there's a large percentage that want to continue to work from home, and there's no reason why not to continue that we can see so far. So we'll continue to evaluate it. Don't plan to go back until after Labor Day in full force, and even then, it's probably going to be a reduced force.
Yeah, makes sense. I got one more question, just to get your thoughts on, and then for anybody that's listening that might have a question for me or Nick or Brandon, please go ahead and type that in, and we'll try to get it answered. Obviously, throughout this process, we've got evictions that were put on hold. Some states you're seeing they're trying to extend that or have extended that even further. I think New York's extended that. No evictions, no rent increases. Something that's been creeping up every year, 2 years in Colorado is rent control. Do you feel like with this last 90 days that's got more steam behind it, at least in our state? And do you see that as something that will continue to have steam, or something that just comes up and we tend to, our apartment association tends to do a good job of making sure that doesn't pass? Nick, what do you think?
Well, I think it's going to continue to come up. I don't think it necessarily is going to have gained steam, but I think for everybody in the industry, we need to be paying more attention, being more proactive. Just this recent round of legislature showed that we have a strong presence led by the apartment association, but everybody with a stake in the business needs to continually be involved. But I don't see it as anything imminent. I see it as something that's going to continue to come up.
Brandon, I'm sure you guys work in plenty of markets, not your markets in particular, but as Greystar that deal with that stuff. What are your thoughts on that kind of moving this way, if ever?
Yeah, so I would tell you that the markets that I deal with that has the most risk is Colorado, and then maybe New Mexico behind it. I think that, there was some legislation brought up this last session, whether it had to do with extending evictions. I mean, I think it was able to be defeated, at the last minute and by a very narrow margin. So, I think we just barely still kind of have that little toehold of enough people that we can get to vote no on it. And so, the legislative session ended, I don't know, was it last Friday or the Friday before, but as part of a deal for them not to put it in legislation, the governor came out and extended some of the evictions as far as the notice period to 30 days. And he still has the ability to do that, continuing to go forward. And so there's talk about whether the industry has to challenge. At some point, we're going to have to challenge, and try to fight for, what we believe are some constitutional rights with contracts, et cetera. But I do think that it's going to continue to come up. I would say the good news is, especially with the evictions, the governor's kind of the last straw that's there until the next legislative session. And so, I'm pretty sure that as evictions go, it's going to get played up in the media regardless of, oh my God, evictions are up, and they're not going to take into account that there wasn't any evictions for 4 months. And, all of a sudden the evictions have spiked. But if you would have, prorated them over the 4 months, as Nick said, they weren't up any. And so there's going to be a lot of outrage, I'm assuming. And so hopefully that all that can blow over before the next legislative session. But, the legislators are not friends of the apartment community right now as a whole. Like, it's not in our favor. And, before they used to be a split house. And so, we had a good defense of nothing really bad happening, but we don't have that anymore. And so we really have to work, each individual legislator by each individual legislator to get the votes. And so that's really where the risk is that, at some point we may lose that leverage.
Yeah, agree. I think we've answered all the questions. We're coming up on our time. Give an opportunity, Nick, any closing thoughts on kind of where we're heading and what your crystal ball says? And yeah.
I think Denver's going to come out of this very strong. I just don't know how long the timeout or penalty box is going to be as far as rents are concerned. I've got 2 lease ups in the early stages, and we're sticking with the pre-COVID pricing models. Just our velocity is slower than hoped on it. So I think that's a big positive, and I think Denver's going to bounce back very strong.
Brandon.
Yeah, so I agree, and again, I don't have a crystal ball to know, how the economy is going to go nationally, and then there's a lot of different things, monetary and fiscal policy, that's going to, either help or hurt that. But however that goes, I do feel very positive on Denver. It's it's one of the, and all the Southwest markets to that matter, with the exception maybe of Las Vegas. I think that one may be kind of a laggard coming out, but I do think the other markets, whether it's Colorado, Utah, and even Phoenix, when you look at markets rebounding, those are going to be, 3 of the markets that are up to the top of the kind of the charts, if you will, on leading the way out. So.
Yeah, I'd agree. I mean, what we're seeing, like I said in the beginning, we've definitely had deal volume pick back up. I just feel like people that are still out looking are firm believers of the Denver market, and more so the asset type. If you looked in 08, 09, 2010, one of the best performing asset classes and one of the first things to come back was multifamily. So I think people are really banking on that and banking on Denver's continued growth as a city. So I feel like we're going to come out of this pretty well and fare pretty well. And I feel like that's why we are seeing, at least in our space, some velocity on the transaction side, where the institutional side may be a little slowed down. We're definitely seeing things pick back up. And the capital markets obviously are helping that. Sure.
I got a question for you. Now, Adam, on the brokerage side. Because we're seeing, we work with a lot of investors, and, some of them have been on the sideline, have a lot of money still ready to deploy. They're trying to figure out values. I would say that most people trying to jump in early are trying to get some kind of discount, for the extra risk that they're taking on right now. And so we've been involved with a few transactions, and it appears that they've gotten some discount for the extra risk. And so what are you seeing in general or on the products that you're selling in the investors?
We're not seeing significant discounts. I mean, obviously, most of the calls we get right now are people that want that discount, want that 10, 15, 20% off. Honestly, NOIs haven't dropped enough for a seller to really justify that. So are we seeing a little bit of a discount? I think it's very deal to deal. Some of them were probably a couple, 1, 2, 3%, a little high to begin with. So maybe they're just getting back to what they should have been. I can tell you, we just recently put under contract a property that fell out due to COVID. So we were in escrow prior to COVID. It fell out, and we put it back under contract to the exact same price in the last 2 weeks, if not a little bit more. But I mean, it was very similar pricing, and so if that's any indication, we're not seeing a ton of drop. Obviously, there's a disconnect in a lot of instances with buyers and sellers, and buyers feel like there's a little more risk in today's market. But we're not seeing a ton of discounts in pricing. And, there's still a ton of liquidity out there. We deal a lot in 1031s because we're dealing with a lot of private clients, and there's a backlog of that because they've extended all those deadlines to July 15th. So there's a lot of people that just need to place money, and I think liquidity up and down the asset classes, from institutional to private client, I still think there's a ton of liquidity out there. And at some point, people are going to either want to get back in and just be okay with the pricing, or they're going to wait and see how it pans out. But there's definitely enough people that are ready to get back in and pay today's pricing. Now, they're not modeling out as much rent growth and things like that maybe we were all doing 6-9 months ago. So I think underwriting has definitely changed, and buying straight pro forma cap rates is a little bit harder and a challenge on the debt side and buy side. So definitely some headwinds, but we definitely are getting positive feedback. I mean, I think everybody in our offices have quite a few deals going on and are very busy. So it's definitely moving in the right direction for our side on the brokerage side. No other questions. Thank you again, Nick and Brandon, for your insights. We appreciate it, and hopefully this helped some people out, add some value. And all of our contact information was on the invite. If you have a question for any one of us, feel free to reach out, and hope everybody has a good day. Thank you.
All right, thank you all.
Bye-bye.